18th. I'm delighted to be joined by Dr. Karen Nakle, CEO of Crystal Energy, Ram Narayanan, Director, VP, Strategic Marketing and Business Development at Vedanta in India, and Andrew Critchlow, Head of News for EMEA, S&P Global Commodity Insights. Thanks so much, everybody, for joining us this morning. Dr. Kara, let me start with you. Let's talk a bit about the data that we just saw come through overnight, which was what everybody is supposedly watching in the oil market, which is China. Economic GDP for Q1, 4.5%, which according to some is more than was being expected, actually. And yet, we haven't seen an immediate reaction, let's say, from the oil markets this morning of this positivity. Where are, how are oil markets viewing the Chinese growth story today as we start the second quarter?
Good morning, Yara. Good morning, everyone. Well, look, China, we've been watching China very closely since they abandoned their zero COVID policy last December. And it is, in my opinion, the main bullish factor for oil markets this year. However, the news that came today, while they are positive, we saw the growth of the first quarter by 4.5%, and it exceeded some forecasts, some expectations of some economists on Bloomberg by half a percentage point, 0.5%, because the expectations were 4%. So that's the positive side of the story. Is it stellar? Is it a fait accompli that China is going to continue to grow robustly for the remainder of the year? I think we should be cautiously optimistic because, first of all, if you look at the National Bureau of Statistics in China, the Chinese official publication for government data, they warn and they openly said that it's too early to say that the growth, the recovery is robust. There is still a lot to do. And domestic consumption has not grown as fast as one would have expected it to grow. So these are the things that take into consideration. And then second factor is that Chinese economy is export oriented. So the outlook for China will also depend on the outlook of the global economy. So if there is a recession in its main markets, its destination, that will feed negatively into China's economic growth. So I think there is a media overhype perhaps this morning because of the data. And I would say it would be really wiser to wait and see how things will unfold in the next few months before we celebrate the comeback of China with a vengeance.
Okay, Andy Critchlow, welcome again and good morning. I want to address that second point that Carol made, which was the second part of the China equation, which is how is the rest of the global economy doing as a consumer of Chinese exports, if you like. And what is the sentiment from the oil markets there today? Everything looks pretty rosy. Oil prices, are still pretty healthy. Russian oil is still flowing and being consumed, obviously east more than west. But what is the current sentiment from the West, Europe, US, slight recession coming up, and what do the oil markets see in that? Are they getting more convinced that we will actually see a recession?
Well, the oil markets have definitely been supported by OPEC's decision to voluntarily cut production, or the decision of some members. So we have seen a bit of a bounce back in flat Brent prices. Our forecast to the end of the year is to see Brent trade at around $90 a barrel, potentially on the upside. We're in the high 80s at the moment. I think that there's certainly a lot of, even with the bulls, there's certainly a lot of skepticism about the strength of this recovery. Some very interesting comments from Christine Lagarde, the president of the ECB, yesterday in a speech that she gave in Europe, which, were quite contrarian to the data that you're seeing from China, still very cautious about the global economy, still very much weighing on the tightening side in terms of central banks. I think it's very interesting how you are getting this sort of dichotomy between the policy of central banks globally now and OPEC. So OPEC tightening production, wanting to inflate oil prices. And then on the other side, you have central banks still very cautious about the impact of inflation, still wanting to tighten policy to contain inflation. That said, minutes of the last Federal Reserve Board meeting in March showed that several members were split on a decision actually to continue raising rates. So I think the key moment now for oil markets in my mind is the next Fed meeting, which will come in May. And if we see the Fed pause on interest rates, then that will act as a significant stimulus to the bullish argument behind prices at the moment. If the Fed continues to tighten, that will increase recession concerns in the US. And ultimately, coming back to Carol's point, I think that is going to be where what really determines the trajectory of the Chinese economy going forward, because it is still predominantly an export economy. All of that said, and it's important to mark this, that March saw I think a record month for crude throughputs in Chinese refineries. So good for the oil market in the short term, certainly.
Yeah, and that was, I mean, partly being attributed to less throughput, if you like, in January and February. So it's all really about what the second quarter does. But yeah, you know, point well taken. And of course, there's so much to come in terms of finance angle and central banks, corporate earnings, etc. Ram, welcome. Let's talk about India. Of course, that is one consumer that is not expecting a recession this year. Quite to the contrary, it is, you know, being dubbed as the fastest growing economy for this year. Absolutely, for sure. Any perturbed at all by the OPEC Plus decision and the boost to oil prices that we've had in the last week or two?
Yeah, thanks, Della. Yes, as you very rightly said, I mean, I saw recently a survey, I think it was on Bloomberg or somewhere, where chances of recession for different countries are put up. And very proud to say that India was put up at 0% recession. I think it's thanks mainly to the capex push by the government, and the consumer demand is still pretty robust. And thirdly, the rural demand, which is a main component of the consumer demand in India, has been picking up. We've seen a pickup in the vehicle sales in rural areas. So that is something that's holding on pretty strong. And finally, if I may add that the inflation also seems to be under control in India. So given that, like, you know, an increase in oil prices certainly is not good for India. And the OPEC decision recently, which pushed up the oil price by $6 to $7 to a barrel, certainly is going to put pressure on the finances for India. So therefore, to answer your question, yes, it's not been a great development, but India continues to import Russian oil. And I guess, given the way the market is structured right now, the import of Russian oil will continue. The latest statistics show that India is importing more Russian oil as more than the traditional suppliers like Saudi Arabia, Iraq, and USA. And it's coming at a discount, obviously. So therefore, given India's energy security needs, where 80% of India's energy security has to be imported, so therefore, like, you know, India will continue to be with the Russian oil. And given the inflation concerns India will have on the energy front, I think it will continue.
Okay, Carol, that word inflation obviously is being talked about as much as, you know, sustainability these days. Let's talk a bit about that in the context of what Andy mentioned of, you know, the signal that the Fed will give in May in terms of rates. Certainly, if they don't raise rates, it'll be very bullish. How will that impact, do you think, oil prices and how that feeds into the inflationary argument? And you know, how damaging has the OPEC move been to the whole movement against inflation that we're trying to see done by central banks?
Well, let me start with the last point about how damaging OPEC Plus voluntary cuts announced earlier this month on inflation. I don't think, first of all, it's too early to tell, but I did not see really major damage because we did not see, of course, prices are higher than before the move, but not really dramatically higher. So we're not in the red zone if we want to talk about damage. Of course, they are not going to make the life of central bankers easier because they do feed into inflation. But there are other factors also that feed into inflation, other sectors. And we should look also at the development in those sectors as well, such as food prices, for example. So it's not, I cannot say that oil that did not have any impact at all. But again, I don't think it has been as bad as many people have expected. In terms of what the central banks are going to do, of course, they are not in a pleasant situation. And what they will be doing next is perhaps as unpredictable for them as it is for outside observers. But in my opinion, I think inflation is still high. If you look at recommendations from international organizations such as the IMF, they are not saying, oh, take a step back and then wait. They are saying, no, continue with your policy because the damage of letting inflation stay at this level would outweigh any potential damage of a slowdown in the economy. So I don't think the story of the central banks. And again, not talking only about the US. The US is in a better position, I would say, economically speaking, than many economies elsewhere. We have to also look at what central banks in Europe and other major economies are also doing. And there, I don't see any second thoughts being given to inflation. So inflation is still high, and maybe things, if they change dramatically by next month, maybe we'll see a pause or a reduction in the growth of rate. But I think at the moment where I'm standing, it will be too early to say that the central banks will change their policy strategy.
Yeah, and of course, you mentioned the Fed and ECB, for example. The ECB has been following the Fed later, but kind of following its footsteps. But of course, the dynamic in those two economies is quite different. And the US is still, and employment figures are still very good. Yes, we have inflation, but everything else seems to be fine. Consumer spending is still pretty strong. But in Europe, of course, things are looking a bit more dodgy, aren't they? Sort of on the ground. But we do have a headline in one of our news bulletins saying German oil imports rose 8% in 2022, right? When supposedly the economies were under pressure from high gas prices initially, etc. So where you're sitting in London, what's the sentiment today in Europe towards oil prices and towards sort of the outlook for the rest of the year, and taking inflationary concerns into consideration?
I mean, the sentiment in Europe is from what I hear speaking to policymakers, is quite hostile towards anything to do with higher energy prices. And of course, Europe's been in the eye of the storm, not just from the perspective of absorbing crude prices above $80 a barrel, but more importantly, natural gas prices, which have been at record highs for most of the winter. That has been largely contained now. Stocks are in a healthy position coming out of the winter heating season in Europe. There is ample supply of LNG now, so we don't expect to see that inflationary pressure coming from natural gas markets in Europe for the foreseeable future. However, all of this could change if we get a further deterioration in the geopolitical environment in Ukraine with regards to the war and whatever that means.
But hasn't Europe already sort of accounted for the fact that Russian gas, the supply situation will be worse this year, obviously, but a lot of people now are saying this coming winter Europe will be okay. 2-3 months ago they were like, next 2023, 24 is going to be the problem, and now they're like, no, stocks are fine unless we have like a deep freeze for 4 months. That panic essentially is over.
Yeah, perhaps they're looking at a different crystal ball to me at the moment. I think it's still very early to gaze into the future in terms of how European gas markets will look into winter 2023-24 season, partly due to the global competition to secure LNG volumes, which has cranked up. Yes, we're seeing more supply coming online, new supply coming from Mozambique. We're seeing supplies coming into Europe for the first time from Australia, but we're also seeing China being very aggressive in the international market to secure future LNG supplies. We reported at S&P Global Commodity Insights last month that CNOOC is planning to open a global LNG trading office in London, for example, to start trading volumes. It shows the belief that they have in the global LNG market now, and wanting to be a player in that market as opposed to just solely securing domestic supplies of LNG. We've had China secure access, I believe now for the first time, to the North Field in Qatar, taking a strategic stake there. We're going to see more of that. Of course, a lot of Gulf producers are wanting to increase their focus on LNG and expand capacity. Where's the finance? Where's the partnership for that going to come from? Well, it's going to come from Asia, and I think it's going to come from China. So Europe's in a tough spot, and I think I'd bring you back to the speech that Christine Lagarde gave yesterday. And one of the, I think, really interesting things that she talked about in that speech was this idea that countries need to club together, to cooperate. And this is a very EU kind of message, I think, coming from Lagarde, to secure supply chains, or I quote, diversify energy production and supply. And, we've talked a lot about OPEC being a cartel, but also policymakers now in the West talking seriously about the idea of creating buyers clubs. We had the head of the Department of Energy in the US allude to a similar thing a few days ago at the Columbia University Energy Seminar in New York. We now have Lagarde making remarks that seem to point to that. What would be the structure of that? I don't know. Could it be implemented in a market? Very difficult. I mean, of course, strategic petroleum reserves, the IEA committing members to hold 90 days of forward cover, kind of acts a bit like a buyer's club. But, you know, are the major consumers of the world going to start to, you know, to kind of fight back in response to what OPEC is doing in terms of prices and supply?
Yeah, it would be interesting to see if Europe can get its act together on that. It took them a while to agree on the price cap and sanctions.
Yeah, I wouldn't hold my breath.
I wouldn't say that's the top of their list. And what is in question, and I wanted to go to Carol on this later, sort of being based in Europe, in Germany, and London, and is how Europe is sticking together on the Ukraine front. Because of course we just saw Macron's visit a couple of weeks ago to China, and that stirred up a whole load of sort of concerns of sort of the common, I suppose, policy that Europe may be showing, at least to the world, on that front. But Ram, just back to you on Asia, and two things I wanted to put to you. Any fallout for India or concerns that India's doing fine with these oil prices? You know, 80 plus. You know, your economy is kind of like running itself regardless. You know, unless we really see prices skyrocket. But what about the countries around India also, and how they are suffering essentially from these high commodity prices in general? Is there any fallout for India whatsoever from that in terms of its immediate neighbors in South Asia, essentially not coping at all, and not just because of oil prices, because of other reasons, but that's compounding it, Pakistan being one of them, Sri Lanka, etc.?
Yes, certainly. I think the fallout is more on the geopolitical front. First, let us take Pakistan. Pakistan obviously is in a bit of a bother, especially with the IMF bailout just about to happen right now. So therefore, not majorly from a trade perspective, but majorly from a geopolitical perspective, given all the issues between India and Pakistan, that can be one of the fallouts. Now, coming to Sri Lanka, India does have a bit of trade with Sri Lanka. Again, it's a geopolitical issue, like, you know, with China's presence in Sri Lanka being one of the sticky points between India and Sri Lanka. Now, Bangladesh is an interesting example. Like, about 2 years back, Bangladesh per capita GDP became higher than India's, thanks to its majorly its textiles markets. So therefore, that was a big news at the time. But obviously, Bangladesh also has been hit majorly recently by what has happened with the high gas prices. So and the global slowdown has also hit its textiles markets also, which is one of the biggest markets for Bangladesh. So India, like, you know, right now has tying up more with Bangladesh. Recently, it's been announced there will be a gas pipeline between India and Bangladesh. And there's been quite a lot of initiatives between both the governments so as to help Bangladesh. So therefore, the government of India is seeing this more as a geopolitical strategy, given the recent crisis across these three countries, and like, you know, and India becomes a major player in this particular arena. So that essentially what is happening with India's neighbors. The other major neighbors, neighbor issues mainly with China. That's a different issue altogether.
Okay, Carol, let me just go to talk about Russia a little bit. In focus, we have again a couple of headline stories. One is saying that Russia's saying, you know, that it's forecasting its output to be stable for the next couple of years. And the other one headline is Saudi and the UAE continuing to scoop up Russian products, mixing them, re-exporting them, possibly using them here, re-exporting instead of and exporting their own products. You know, what's the outlook for Russian production from what you're hearing for the remainder of the year, both on the upstream front in Russia from a functionality point of view, and do you see these sanctions are going to bite any more this year, practically speaking?
I mean, it's interesting. I was thinking that you were going to add also the reference to the fact that the 500,000 barrels a day that the Russians said they would cut, they have not really materialized based on certain reports. But we have to also acknowledge two things. First of all, data on Russia is not accurate these days, right? So whatever data comes from Russia on Russia has to be doubly questioned. And second, don't forget that OPEC Plus announced these voluntary cuts earlier this month, and whatever OPEC Plus cuts, Russia does not have to cut. So that's another thing we have to take into consideration when thinking about the outlook for Russia. Now, of course, in the short term, the situation is not going to look any different from where we are today or earlier this year, because when it comes to sanctions, and it's not only sanctions, it's the fact that Western investment left Russia in upstream oil and gas, at least. And that will have the impact, we'll feel the impact in the longer term because there's a time lag between investment and production. So while today Russian oil production looks resilient, its export looks resilient because of the nature of oil markets where you redirect flow from one market to the other, and that's what has been happening. But in the longer term, I doubt we're going to see a stable Russian oil production unless investment picks up, because everybody, even officials within OPEC, they say we need to increase investment to just sustain production. So the same logic can apply on Russia. If you don't have the same investment, then you would expect production to decline. Otherwise, I don't see how the Russians can maintain the level of production for several years to come. And this is where you can see the impact of sanctions biting. Look at Iran, for example. Iran is producing today less than half its peak before the revolution and the sanctions. So it's something, sanctions are more for the long term than for short term.
Okay, and I mean, would you see, just sticking to not sanctions, but on the OPEC front, with the point you were making, and Ram was saying how India is going to continue to take Russian oil, and for a couple of months that surpassed, the volumes have surpassed traditional Gulf volumes. Are Gulf producers bothered by this, do you think, or is there enough demand to go around?
I mean, I don't think, first of all, that in terms of bothered, of course, nobody likes to lose market share, but they're also gaining the market share of Russia in Europe. And I don't think they should be too worried for the long term. And we're seeing how they have been cementing their relationship with Asian powers, the Saudi Arabia and the Chinese, the Qataris and the Chinese, all the deals that we heard about. And we're going to hear more about in the long term, because if you put I don't call them noises, but the short-term developments, if you look at the long-term picture, which has been developing for many years now, we could see the Middle East and Asia, particularly China, are developing a long-term relationship. We're talking about the major growth center for oil demand in the future and the major growth center for oil production in the future. So it's a natural development. So even if Russia takes a bit of market share today, I don't think it's in a strong position to steal market share from the Middle East in the longer term in that market. Okay,
thanks, Carol. There's our survey question for the day, which is about the China GDP, which we started with, which is the Q1 figure, 4.5%. Is that bullish or bearish for oil markets? You know, so far we've seen a sort of, I suppose, neutral response, you could argue, but let's get the result of that a bit later. Ram, let's talk a bit about, sorry, just to back to you before I go to Andy. Just to follow up on the activity in the Indian economy and just look at the refining sector, the refineries and the plans for that. I mean, Carol just alluded to the fact that it's going to be also a bigger and bigger production center as well in the future in terms of products and perhaps you know, other commodities. So where are we on that front? And does that factor into India's thinking in terms of, you know, what the immediate future looks like? More Russian oil, not more Russian oil, its relationship with the OPEC countries, etc.
Yep. See, right now, a good part of the Indian refining sector, linked to the private sector, as well as a good part of the public sector, have been taking up the Russian oil. So therefore, the Indian refining markets have been doing pretty well. The margins have been extremely good over the last 2 years. So therefore, in the sense that, you know, the Indian refining sector has done pretty well. And they have literally reconfigured their operations to take Russian oil. Moving forward, there's a bit of investment which is coming up in the Indian refining sector. And one of the major developments that's happening is, like, you know, many of these refiners also looking at and integrating the downstream petrochemicals also. So therefore, like looking from a future perspective, the demand for oil will remain firm from the refining sector. It will be driven mainly by the consumption of fuels in India, as well as some part by the chemicals production in India. And also, India is a big export hub also. The private sector from India exports quite a lot of petroleum products to Middle East, Europe, and other countries. So and that demand will remain strong. So therefore, the outlook for the Indian refining sector is pretty firm and pretty strong, as I would say.
What's the feeling today about China, in a sense, and its position? You know, we've had obviously India and China both sort of be neutral on the Ukraine war position, if you like. China, would you say that India wants to weigh in more on what's happening? It sort of has conflicted interest, doesn't it? India needs to still stay very in good relations with the West, and it's sort of in its economic and political model, and yet and feels like China is a sort of a threat from an economic point of view as well. What's the viewpoint of India going forward on this Russia-Ukraine war, would you say? Is it going to maintain its stance? Is it going to be shifting a little bit?
Well, I think my guess is maybe there won't be much of a big shift in stance of India. So India has been a neutral stance, like because India is a big market for Russia, especially in the arms sector, and now for the oil sector. And India traditionally has got pretty good relations with Russia. And India in the last 20 years has had a big shift in terms of geopolitical strategy with the Western nations also. Of course, the China factor does play in, with China, Russia getting a little bit more closer right now. But India's neutral stance has to continue given its geopolitical considerations and given its market considerations. So I would suggest I would think that India will play a similar kind of view, a sort of a neutral view between Russia as well as the Western nations. Of course, the view is that if the war stops, there'll be less pressure on the energy markets as a whole, which will benefit the Indian economy. So India's stand will still continue as it is. I don't foresee any major change in India's foreign policy stance going forward in the future.
Of course, it's just about to open its first Apple store, though, on its mainland, which is exciting from the American sort of investment point of view.
Oh yeah, the store which Tim Cook came was just a few meters away from where I sit right now. So yeah, it's been pretty interesting right now.
Yeah, I actually was surprised to hear that there wasn't an Apple store in India. I was not aware that there wasn't an Apple store. In Delhi, it's one flagship store. So that came as quite. I know that they've moved operations there as well in terms of manufacturing parts, but I wasn't aware that the retail wasn't there. Andy, let's go back to you and look forward a bit, forecasting on prices, price outlooks for the second half. A lot of the talk at the end, at the beginning of this year was, the second half is going to be much stronger. China will definitely be back. We'll have more clarity on the Western economies. So any feeling that we may have a shock to the system in the second half from a demand point of view from China? Or is that priced in? Everyone's saying everything's priced in. All eventualities are priced in.
Yeah, it's a good question. I mean, we changed our forecast based on OPEC and their voluntary decision to cut. We said that you could see a $5 bump in prices as a consequence. That's kind of where it's landed. We're saying by the end of the year, $90 per barrel for crude is realistic. Could it go higher? Well, of course. I think the geopolitics at the moment is very volatile. Interestingly, China's defense minister Li Shangfu in Moscow yesterday to meet Vladimir Putin. Of course, Shangfu was sanctioned in 2018 by the US government for facilitating arms transfers from Russia to China. Obviously, a lot of concern now that China is seriously negotiating with Russia to supply military technology and other technology, and obviously that has been spiked by Shangfu's presence in Moscow, which has been very heavily publicized by the Russian government and the Chinese government. Will that prompt US policymakers, EU policymakers to intensify arms transfers to Ukraine? Fighter jets, F-16s, ground-to-air defense missile systems. That, of course, will intensify the conflict. And then to bring it back to what does that mean for crude markets? Well, attention then comes back to the cap. G7 ministers have said they're not going to adjust the cap. Is this sustainable? Well, clearly the cap isn't work. Well, it depends whether you think the cap is working. The narrative from the US and G7 policymakers is the cap's doing everything that we want it to. It's allowing Russian crude to flow, but it's not making a profit for the Russian government. The reality on the ground, however, is that Russia is still a major supplier of crude oil around the market, and that is ultimately providing the economic juice to sustain their war in Ukraine. Without that revenue from crude, then they can't do that. So let me
just stop you there and just get it quick before we run out of time. But what about the impact on products? And I wanted to get to that. We just had a comment on jet fuel, how jet fuel is doing generally. Diesel has been having some impact, obviously, from Russia. Russia subsidizing its diesel as well. It's having more of an impact on products, isn't it?
Well, I mean, yeah, I mean, you're getting huge amounts of Russian product, finding its way into, primarily Asian markets. That said, bunker sales in Fujairah last month hit a record low. I think that the refining market in Europe at the moment is in turmoil. Cepsa, Spanish refineries, said that their throughput, I think, fell something like 7% in the first quarter. France, most of its refinery sector in March was knocked out because of strikes. We now have strikes in the oil sector in Norway, which will affect some refineries there. We've had industrial action in the UK. So, Europe as a kind of refining hub is in flux at the moment, and most of that is inflation and industrial action related. The US, the situation, as you quite rightly said at the beginning of the podcast, is in a better situation economically. How sustainable is that? Well, again, we come back to the May meeting of the Fed, and if they continue to tighten, it heightens the increased chance of a recession in the US. If they back off, then does that let the dogs of inflation out? And global economies are just going to have to suck up higher prices for the foreseeable future. All of these things will have an impact on products. All of these things will have an impact on oil.
Of course, and we didn't talk about US production today because, again, that's been a question for the last year. Why hasn't that sort of increased more gradually as these healthy prices have come into the mix? Having said that, we had an interview last week with a US energy analyst who said, people keep saying US production isn't increasing, but we are still, 12.5 million barrels a day, and we have not peaked, and we will not peak this year. So there is still some forward thinking that that's going to creep up. But I'm afraid we've run out of time. We did see the results of that survey very equal across those three answers. A slight edge to the bullish scenario, 38%. But we'll have to wait and see really if that is going to materialize. Dr. Carol Lackley, Andy Critchlow, and Ram Narayanan, thank you so much for joining us this morning. Have a great day.
Thank you.
Thank you.
Thank you. Thanks, everybody. Thank you.